Now, in an economy where retailers are keeping future expectations in check due to a low consumer confidence levels, rising unemployment as well as low economic growth forecasts, the Clicks Group has seen a jump in its share price of 48% over the past year. In studio to discuss the outlook for Clicks is Finweek contributor Moxima Gama. Good to have you with us today. Clicks is certainly doing something right with regard to the share price after the run we've seen, but what does it entail? Why are we seeing this significant rally?
Look, there's a few things. One of them is they've got a very simple strategy. And although they have about 17 stores in the southern part of Africa, they decided against having to expand aggressively into Africa. And they figured there was more growth in South Africa. So they opened a few stores in the township areas, which has proven to be quite profitable for them. So they're seeing that at least that expansion program is increasing or is on continuation. Then there's also good partnerships they've made and franchise agreements with the Body Shop, as we all know, and what is it?
Musica as well?
Thank you. Although Musica lacks a little, but they're also getting into a strategy that's going to at least help them, and Body Shop is undoubtedly at least increasing their earnings, and it's their in-house brand. And more significantly would be the dispensary units that they have in the stores, which we all know that the pharmaceutical part is quite lucrative. So that's
Tell us about that, because it is also working in a competitive landscape with the likes of Dis-Chem, which isn't listed, also competing in that environment. But I understand that's where the real growth comes from. Yeah,
they actually got in, they partnered, or they started being members with UPD, which is the United Pharmaceutical Distribution, which is the biggest pharmaceutical wholesaler in South Africa. They supply medicines to hospitals, clinics, doctors' rooms, and they're currently managing at least 90% of the deliveries, which is quite substantial. They're giving them good earnings. I mean, in the results, they increased the turnover was 6.5%, and that was just on lower inflation and increasing generic sales of medicines, the generic medicines. Yes. So that was a good move on their side to add that onto their store, which is now at least helping with the share prices going up.
The outlook though on the share price, we've mentioned the macroeconomic factors, consumer growth, economic growth as well, inflation and interest rates also playing an impact, but could we see the share price maintain this significant rally?
I'm pretty positive on it. There was a bit of a consolidation, and if we put technical analysis in it, it's known as an inverted head and shoulders pattern, and above 105 that would break the neckline, and we could see at least a 30% rise, which is nice. It's quite a good return there. And if they just stick to the strategy they in, Clicks remains a very one of the best defensive stocks in the in the indices. So if they stick to what they're doing and at least investing that capital in South Africa, as it's doing very well for them now, then they could maintain that investor confidence, and that could increase the share price at least.
Just sidestep for a moment the valuation of the share price in comparison to its peers. So often we hear that retailers are expensive. Is that the perception that still remains?
I think in this consolidation phase, it showed although they are expensive, there's still room for growth for a lot of the retailers, which have come off pretty significantly. So from that correction, we could see a lot of upside, I think, in at least in the medium to long term. So after that pullback, these are probably the best times to get into retails. I would really start beefing up on the retail stocks, actually.
Buying in the dips, we see. Hey, Moxima, thank you so much for your time today. That was Finweek contributor Moxima Gama. Stay with us. Up next, we unpack this week's cover story.